Hello, I'm Ron Wilson. In this month's news, the Insurance in Superannuation Working Group, comprised of key industry figures, has addressed the areas in which it says default group insurance in superannuation could improve. Housing data released in January showed that prices across Australian capitals remained strong in 2016, defying the opinions of many experts. Australian super funds enjoyed a positive 2016, with balanced option accounts up 7.2% on average for the year. And in international news, the Fed has hinted at 3 further rate rises for the US this year, while the Chinese authorities will be looking to continue the momentum from strong fourth quarter 2016 economic results. Michael Pollock has the details.
Members of the Insurance in Superannuation Working Group, or ISWG, say default group insurance in superannuation has resulted in better risk protection for Australians from all walks of life, but there is room for improvement. The ISWG was established in October 2016 to openly and proactively identify weaknesses in group insurance in order to raise the standards of the system and develop a code of practice. The group is chaired by Dai-ichi Life Asia Pacific's Director Jim Minto. The group's key priorities are improving cost impacts on account balances for consumers, including the right cover for young people, addressing multiple default insurance policies, providing better assistance to consumers during claims, and improving superannuation fund member communications on insurance. The group consists of 2 tiers: a governance board and a technical working group, which is responsible for developing the priorities determined by the governance board. Data released in early January by research firm CoreLogic RP Data revealed that dwelling prices across Australian capital cities in 2016 defied the opinions of many industry experts that the market would experience a subdued year. The December CoreLogic Home Value Index showed capital city dwelling values rose 1.4% in that month, taking the yearly gain for 2016 to 10.9%. As expected, Sydney led the charge for individual markets, rising 15.5% year on year, with Melbourne close behind on 13.7%. Hobart and Canberra surprised many with year-on-year increases of 11.2% and 9.3% respectively. Perth was the only market to show a decline, with prices dropping 4.3%. According to CoreLogic RP Data, dwelling prices in Sydney have risen 97.5% since January 2009 and 83.5% in Melbourne over the same period. Figures released by Super Ratings showed that a Santa rally pushed Australian balanced option superannuation accounts up 2.1% in December, with a return for the 2016 calendar year of 7.2%. This was slightly below the 7.7% per year average recorded for the previous 7 years. The positive result was achieved despite ongoing concerns around low global growth and market volatility late in the year. Following its decision to lift its interest rate range for just the second time in a decade in December, the US Federal Reserve strongly hinted at further increases across this year. The Fed moved to increase its target band to 0.5% to 0.75% at its December meeting, an increase of 0.25%. The decision was prompted by the central bank's confidence that the recent growth in the US economy will continue, as well as low unemployment and rising inflation. The Fed also flagged 3 more 25 basis point rate rises across 2017 to a median Fed funds rate of 1.4% by the end of the year. Further, Fed officials predicted a median rate of 2.1% by the end of 2018 and 2.9% by the end of 2019. The Chinese economy showed gains across all industries in the fourth quarter of 2016, according to New York-based CBB International, a respected source of Chinese economic survey data and publisher of the China Beige Book. More than 3,300 companies and 160 bankers were surveyed across China. The report noted that revenues, profits, jobs and capital expenditures were up from the third quarter, while new orders remained stable. The positive results ran contrary to the Dow 2017 predictions for the world's second largest economy from many China watchers. CBB International noted that 43% of firms embarked on hiring in 2016, up from 30% in 2015. China's industrial profits saw a lift of 14.5% year-on-year in November, up from 9.8% in October and 7.7% in September. However, companies in all sectors reported worsening cash flows. ASIC has smoothed the way for fintech businesses to test their technologies with the release of class waivers for eligible businesses to allow them to test specified services without the need to have an Australian Financial Services licence or Australian credit licence. Launched in December, the exemptions are the first of their kind in the world. On the same day, the regulator released Regulatory Guide 257, testing fintech products and services without holding an AFS or credit licence, to provide guidance on testing fintech under the exemptions. The exemptions include existing ASIC relief for certain foreign exchange services and non-cash payment products, for example stored value cards, ASIC's fintech licensing exemption provided under certain legislative instruments, and tailored individual licensing exemptions to facilitate product or service testing, similar to the regulatory sandbox frameworks established by regulators in other jurisdictions. The licensing exemption allows eligible businesses to test specified services for up to 12 months with a maximum of 100 retail clients, provided they notify ASIC before testing begins. ASIC has allowed fund managers to expand the range of managed investment products available to retail investors on the ASX's M-Funds trading platform. The ASX made an application to ASIC for the expansion, which has been granted from February. Previously, fund managers could only provide simple managed investment schemes with shorter PDSs to retail investors. Under the new rules, products must comply with criteria relating to the liquidity of scheme property and redemption of units. In December, the ATO released its yearly statistical report on the SMSF sector, Self-Managed Superannuation Funds, a Statistical Overview 2014-15. At the same time, it released the September 2016 edition of its quarterly Self-Managed Superannuation Funds Statistical Report. The ATO's Assistant Commissioner Casey McFarlane explained that the annual overview data showed that the sector continued to grow, with positive returns on assets and increasing fund and member numbers. SMSFs now account for 99.6% of all superannuation funds and 29% of the $2.1 trillion in total superannuation assets in Australia. In the 5 years to 2015-16, the number of SMSFs has grown by 31% to 577,000, with total assets worth $622 billion. The report also revealed that average member balances have grown an average of 21% in the past 5 years, and SMSF members are getting younger. The median age of members in 2015 was 48 compared to 55 in 2011.